Hey, what's up? This is Jerry Fetta, owner, founder, and CEO of Wealth DynamX. I want to give you a quick intro to the Sacred Account page and also to my friend Chris Naugle. So you're used to seeing me on all the Sacred Account videos. You're still going to. I want to introduce my friend Chris on the video you're going to watch here in a second. Chris is one of the very top people in the Sacred Account industry. So he works with an agency we've partnered with called the Money Multiplier agency. Chris is a professional snowboarder. He did things like the X Games. He's been in financial services, much like me with my background. He started as a financial advisor, worked for several private wealth management firms, managed millions of dollars, and he started learning the truth about how money really works, and it turned him on to the sacred account concept, also known as infinite banking. Chris is someone that you're going to be seeing more of. In this video, he's going to give you a presentation about how this concept works, how the sacred account concept works, how the infinite banking concept works, really the idea of taking high early cash value, dividend paying whole life insurance and using that as your own banking system, right? Just like the top banks do, just like the wealthy have done. Pay attention to this video. That's who Chris is. I wanted to make that warm introduction so you understand that he's a partner of Wealth DynamX now. He's somebody you're going to see more of, and I want you to enjoy the content, watch the video, and be sure you click the link below to schedule your free consultation with our team with the Money Multiplier agency as well to set up your sacred account.
Today, I'm going to teach you what the Money Multiplier method is, and I'm going to show you how to map out the millionaire mystery. What if you could get all the money back for every purchase that you've ever made and create wealth through your own debts and expenses that you already have? If you're like most Americans, you've spent most of your adult life paying the banks and creditors and expenses, and at the same time, you've watched your retirement funds and your legacy dramatically fluctuate or evaporate in the markets. You've been taught to have control of your finances. You've been taught to assume risk, and it's costing you your financial freedom. The wealthiest people know differently. The multimillionaires, the billionaires, they do things differently. And what I'm going to expand on today in this presentation is a 200-year-old strategy that's used by the wealthiest to eliminate their debt, to grow their wealth, to minimize their taxation, and to leave a legacy. And I'm going to show you how to do all of this without taking on any risk, without working any harder, without changing your cash flow, and without losing control of your finances. This presentation today is going to show you how you can become the bank. But before we do that, you've all heard the expression, if it sounds too good to be true, it must be. Well, that's what I thought when I first heard about the Money Multiplier method. And how many of you have ever wanted more money for just about anything at all? If you said yes to any of those questions, the answer is you are in the right place. And today I'm going to share with you a little known but powerful wealth strategy, a wealth strategy that will completely change your financial future, just like it changed mine. We're going to talk about your money. We're going to talk about your wealth. We're going to talk about how you can live just like the wealthy using their exact techniques. And we're going to cover exactly how you can keep control of your money and how to build wealth and how to keep your wealth in your family. And I'm going to show you how to pay off debts. And I'm going to show you how to pay your expenses and your overhead, but I'm going to show you most importantly how to recycle and recapture all of the money just like the banks do. This is going to be some out-of-the-box thinking. Okay, and I'm going to challenge you to keep an open mind throughout this entire presentation because I'm not selling you anything. I'm simply showing you the path and the things that I learned so that you can change your financial future. And as we go through this webinar, you're going to have questions. I'd like you to hold your questions, type them in, and I will make sure I answer them. Or at the end, you're going to have the ability to set up a time where you can ask questions directly to me or my team. So before we get into any of that, I want to play a quick video for you.
Chris Naugle is a nationally recognized entrepreneur from Western New York. In his 16 years of high-level experience in the financial services and advisory industry, he has managed over $30 million in assets, specializing in alternative investments, retirement strategies, and wealth accumulation. Using his expert knowledge in finance, he has successfully bought, renovated, and flipped hundreds of properties. Through his passion and success at real estate, Chris and his wife Larissa's renovation designs have been featured on HGTV's House Hunters, My Lottery Dream Home, and their very own show, Risky Builders. But where it all began was a 16-year-old with a t-shirt company in his mom's basement. A dream of becoming a professional snowboarder, owning a skateboard shop at age 17, and a lot of imagination. Here he is. Welcome to the stage, Chris Naugle.
All right, so this is what we're going to get into. We're going to get into the Money Multiplier. And for all of you, I'm Chris Naugle. There's my phone number on the screen, and there's my contact. And you can also get more resources right there from the website. You just go to themoneymultiplier.com, or you can also go to chrisnaugle.com for all sorts of free trainings and other information. If you like this, there's a lot more about how this concept can work and how it can be used in your family. But let's talk a little bit about statistics. You see, all of you on this training right now, you are part of what I call the 5%. You're part of the 5% because you're here. And the other thing is, if I were to go around and I were to ask 125-year-olds whether or not they're going to be wealthy and successful by the age of 65, every one of those 25-year-olds would say yes. I probably wouldn't even get the question out of my mouth. They would all be so excited about it. They would be, of course I'm going to be, why do I have to wait to 65? However, something happens from the time when they're 25 to the time when they're 65 that changes that whole dynamic. In this page right here, 5 out of 100 people will be financially secure at the age of retirement. That's a statistic from the Social Security Administration. How is that even possible? The last time I checked, this is the United States of America, the greatest country on earth, the most powerful country we can live in. And this is statistics. This is what we can expect. And I'm sorry, I'm not willing to accept that. And you shouldn't be either, which is why you need to be the 5%, because out of those 125-year-olds, only 5 of them are going to be financially secure, because most of them decided to conform to what everybody wants them to know, to what everybody wants them to believe, and to what everybody needs them to do. You, folks, are different because you are the 5%. You are the creators. The 5 right there on the screen, the 5% are the ones that create their own destiny. But you need some knowledge to be able to do that. You need to take back control, not only of your life, but of your money in order to accomplish this. And that's what I'm going to show you today, so that you don't become part of the statistic, and so that you don't become one of the people that reach the age of 65, 75, and 85 and are still working into your retirement, not because you want to, but because you have to. That is what we have to change, and we have to change it right now. So who am I? That's usually what I get. A lot of people want to know, who's the guy behind the camera? Well, let me give you a little insight of who Chris Naugle is. I was raised in a lower middle class family by my mom. She was a single mom. And I know what it takes to build something from next to nothing. My success and national acclaim have come in large as part of what I've learned firsthand from the financial struggles that I've faced growing up and through my own ups and downs. I've almost gone bankrupt. I've failed so many times I can't even count. But these experiences forced me to carve out a new lane and to innovate, which led me to discover a better way for wealth, not just for me, but for all of us. I became an entrepreneur by starting a clothing line at the age of 16 years old in my mom's basement. And I did it with a $500 loan from my local credit union. And at the time, my number one dream in life was to become a pro snowboarder. And the clothing line was nothing more than a means to pay for that journey. As I traveled around to the different snowboard competitions throughout the East Coast, I sold my clothes to shops along the way. Like if there was a snowboard or skateboard shop, I'd stop and I'd sell my clothes to them. After a year of doing this, I had my clothing line in about 20 different shops across the Eastern Seaboard. And I was making enough money, just enough, to support that dream of becoming a pro snowboarder. But to get to the next level, I wanted to open my own shop. I saw all these shop owners along the way, and I wanted that because I was a dreamer. Even though I didn't have the resources back then, I was always the dreamer that was never willing to quit. I was always going to push forward. And that's exactly what you all should do as well. At 17 years old, I had to qualify for a $300,000+ loan to make this happen. Now, the loan required me to have roughly about $70,000. That $70,000 is something I just didn't have. I had a '86 Buick, I had a dirt bike, and a baseball card collection. But my mom decided to take a leap of faith. And my mother put her house, the only thing she had in the world, and that house had exactly $70,000 in equity on it. And she put that house on the line so that I could chase my dream, so that her punk 17-year-old snowboard kid could chase his dream and open his first shop called Fat Man Board Shops. That store, Fat Man Board Shops, opened in 1994, and it's still alive today. I sold it off in the mid 2000s to a friend of mine, but that experience allowed me to follow my passion, and my passion was always snowboarding. In 2001, when the recession hit, when the planes hit the towers and the dot-com boom hit, everything came to a halt. I ended up having to find a different path, a path that helped me get by financially. And I ended up in the world of finance. I ended up as a financial advisor. As many things in life unfold unexpectedly, I ended up loving finance. I loved being an advisor and I thrived on it. It taught me something really important about what it meant to be an entrepreneur. What it taught me is it taught me to work on my businesses, not in my businesses. I was out doing the financial advisor, doing the Wall Street thing. My stores continued to build, but I worked on them and I hired people that did things better than I could have done. That was a very important, critical step in my entrepreneurial journey. After excelling as a financial advisor, I became a real estate investor and once again found myself at a crossroads in 2008, right when the Great Recession hit. When the Great Recession hit, I had embarked on a new journey, a new dream, to buy a dilapidated paint store and convert it into a multi-unit plaza where I was going to move my store Fat Man as the main tenant of that plaza, and I was going to rent the other two out and they were going to pay the mortgage. But the Great Recession hit, that brought me to my knees. It literally almost bankrupted me. I was one payment away from being completely bankrupt, and I'll never forget the night that I came home and I had to literally ask my girlfriend, who just moved into my house, to help me pay the mortgage. I had a 50-50 shot of whether or not she was going to stick around. And you know what? I think she kind of liked me because she ended up staying. We ended up getting married, and now we have a 7-month daughter while you're listening to this. But why I talk about that and why I mention that is at that point, that's when I started seeking the unconventional knowledge about money, and everything you're going to hear me speak about was something I learned at this point in my life. I had failed in the early 2000s. I failed again in 2008, and I lost it all again in 2014. I started seeking the truth about what the wealthy do with money. And I realized that everything that I was taught about money was the complete opposite of what the wealthy actually do with money. And that's where the journey really begins, folks. That's where we're going to start. Because at that point, I dedicated myself, I dedicated my journey to be a journey where I empower you to take back control of your money. And I'm going to empower you through the different things that I've learned by studying and following the wealthy around, the multimillionaires and the billionaires, and learning what they do different with money than what you've been taught. So let's dive right into that. And let's start with this right here. Earlier, I had mentioned that a lot of you are going to think this sounds too good to be true. And what do we do when we hear something that's too good to be true? We ignore it, we walk away, we disregard it. Well, if this 200-year-old concept is too good to be true, then why is it that all the wealthiest people have used it? The Rockefellers, the Rothschilds, the Morgans, the Stanleys, Ray Kroc, Walt Disney, Joe Biden, McCain, and I could keep going on and on. And not only that, why is it that it's talked about in some of the most popular books by some of the most popular authors? Books like Second Chance from Robert Kiyosaki. This book talks all about this concept in it. How about this book? Tony Robbins, we all know the big guy, right? Money, Master the Game. Section 5.2 talks all about this concept. And Becoming Your Own Banker, which is the book that kind of began this whole journey for so many. And it was written by R. Nelson Nash. All of these books talk about this, as well as the book that I wrote with Brent Kessler, Mapping Out the Millionaire Mystery. This book also talks about it. And you're going to have the opportunity to get a copy of our book for free. But let me talk a little bit about this picture on the screen. What you're looking at here is a bicycle. But not just any bicycle, this is a backward bicycle. And many of you, when you were a kid, you all learned how to ride a bike, right? When you were young, your parents got you a bike, they put the training on, and you sat on that bike, grabbed the handlebars, and you pushed your foot down, and the bike went forward. You started to learn what you needed to do to make this bicycle work. When you turn the handlebars to the right, the bike went to the right. When you turn the handlebars to the left, the bike went to the left. You started learning this new technique, this new experience in your life, which was how to ride a bicycle. But then your parents did something cruel. They took the training wheels off. And when they took the training wheels off, you probably fell. You got bumps, bruises, scrapes. Some of you cried, but you know what you did? You didn't quit. You got back on that bicycle and you continued to learn how to ride it. Some of you went on to ride wheelies and do 360s, but all of you mastered the art of riding a bicycle because you were taught how to ride that bicycle. But what would happen if the bike didn't work that way? What would happen if when you got on that bicycle and you turned the handlebars to the right, the bike went to the left? And when you turned the handlebars to the left, the bike went to the right. Could you ride the backward bicycle? Well, a lot of you would say yes. A lot of you would say, of course I could. But the answer is you could not. And if you think you could, watch the video on YouTube called The Backward Bicycle, and you will certainly see that you could not ride this bicycle. But you know, it's interesting because when you learn something one way, it's very difficult to change that way of thinking. And the exact same thing is true for money. Since you were very little, you've been trained to think about money a specific way. But what would happen if I told you that what you were taught about money was wrong? It would be very difficult for you to change to this new way of thinking, just like it's going to be very difficult today for you to see how this works. But not just that, it's not impossible. It would not be impossible, and eventually you would learn how to ride this backward bicycle, just like eventually you will learn how money really works. If and only if you choose to change one thing. And let's get into that. First, let's talk about the mysteries of money. What is the definition of money? Many of you have a different perceived notion of what money really is, but the true definition of money is nothing more than money is a means of exchange. That is all that money is. It's a means of exchange. Money for food, food for money. Money for car, car for money. Money for house, house for money. It's nothing more than a means of exchange. And then if I were to ask you, what company uses compound interest? What would you say? Well, most of you would say, well, banks. Banks use compound interest. Some of you would say Wall Street, and someone else would have a different answer. But the answer is not one business in the world uses compound interest. But let's focus on banks because that's the most common answer. Banks do not use compound interest. Banks charge you compound interest, okay? Banks pay you compound interest, but they don't use it themselves. And to use this as an example, what if you took a $20 bill like the one I'm holding in my hand right here? And if you wrote your name on this $20 bill and you went into your local bank and you handed it to the teller and you said, excuse me, Mr. or Mrs. Teller, I would like you to put this $20 bill in the little box in the back with my name on it. Is that how banks work? No. The bill goes into motion immediately and it gets lent out in those little cubicles behind you. You see, there isn't a business in the world that uses compound interest, nor do banks. Banks keep money in motion, just like you should. But you've never been shown how to do that. You've been taught to park your money and leave it in someone else's control. But today that has to change, because if I ask you this question right here, are your dollars worth more today or in the future? Is this $20 worth more today or in the future? What would you say? Well, you would probably tell me that that dollar is worth the most today. At least that's what I would hope. And if you don't think that that's the case, then think about 20 years ago, how many candy bars you could have bought for $20. And the answer is a heck of a lot more than today. How about taxes? Do taxes go up or do they go down? And would you rather pay tax on the seed or the harvest? Let's talk about the first one. Do taxes go up or go down? Taxes almost always go up, right? Even if they don't go up, don't they just find more crap to tax us on? And wouldn't it make more sense to pay tax on the seed versus the harvest? The answer is yes. And I'm sure all of you are agreeing with that. However, you don't practice what you preach, because chances are all of you are using a 401k or putting money in a 401k or some type of employer-sponsored plan, an IRA, a 401k. And what you're actually doing is when you put money into that 401k, you are actually giving up today's dollar in exchange for weaker dollars later. You're actually compounding the tax because the tax is always going to be there. And when you pay the tax on the money someday later, 59 and a half or beyond, you're going to pay tax on a larger amount. You're not going to pay tax on the seed, because if you paid tax on the seed, you'd pay tax on the dollars today, not future higher dollars. So this is a funny thing, because what people have been taught to do is give up control of their money, just like I explained a second ago. We've literally been taught to do things with money that we would never, ever do with things that money buys. Let me give you an example. Would you ever go out and buy a loaf of bread from your local grocery store or bakery, bring that loaf of bread home, put it in the freezer, close the freezer door, and wait 5, 10, or 15 years, then come back, open the freezer door, take out that loaf of bread and look at it and say, yum? No, it would be freezer burned. You would never eat that loaf of bread. How about this? Would you ever go and buy a brand new car and wait 5, 10, or 15 years to drive that car? No, you would not. But that's exactly what you've been taught to do with your money. You've been taught to give up control of your good dollars today and exchange them for weaker, higher tax dollars later. And if you want to be good at money, then you need to start changing who's in control of that money. And let's say, I get this one all the time. Let's say you get a match on your 401k. People rationalize why they put money in their 401ks all the time. Oh, it's the tax deduction. You're paying tax on the harvest, not the seed, right? But the other thing that people will always tell me, yeah, but Chris, I get a match. Well, let's use that loaf of bread example. If I went to the store and I bought a loaf of bread, I put it in the freezer, and I came back 5, 10, or 15 years later, and I opened the freezer, and now I have 2 freezer burned loaves of bread. Would you be happier? No, exactly. The one thing that I know that most people, if I ask you what you know about your retirement account, I can tell you what you know. You know very little. You know whether you're maybe in a conservative, moderate, or high risk tolerance, and you certainly know that when you get the statement, your balance went up or down. But that is about all people know about their 401ks and retirement plans. And up until this point, you've been taught to just accept the traditional way of thinking about money. But to truly build generational wealth, you need to challenge those old concepts, and you need to understand how money really works. So let's dive in. How does your money actually flow? Well, let's just assume that somebody listening to this today is going to be buying a new car this year. And let's call it a $25,000 car. Now, don't get hung up on the price. This works for a Ford Focus or a Ferrari. We just got to add some zeros. But let's assume also that you've got some money parked at your local conventional bank. And your local banker, I'm going to pretend that's me, Banker Chris, says that our bank will pay you a guaranteed 4% in your money. And you come into the bank and you say, Chris, I need to take out $25,000 out of that really good bank that's paying me 4%. Because let's be honest, folks, if you found a bank paying you 4%, would you think that you found yourself a really, really good bank? Absolutely. So you come in and you say, Banker Chris, I need to take that $25,000 out because I'm going to go buy a car. And I say to you, hold on a second. Wait just one moment. Don't do that. How about this? How about our bank gives you a loan for $25,000. And what we'll do is we'll do that $25,000 loan at 6% for 60 months. And we'll just use your $25,000 in the bank as collateral, which means now your $25,000 can stay in the bank earning a compound interest of 4% over the exact same time frame of 60 months. And it wouldn't matter if the time frame was different. But then I say to you, our bank, that really good bank, will pay you more money on your $25,000 earning 4% than you will ever pay us on that $25,000 loan at 6%. Is the banker Chris, telling you the truth? Is it possible to make more money over 5 years earning 4% on that $25,000 when you're paying 6% on the $25,000 loan? Now, most of you are thinking about this saying, absolutely not. Banker Chris, that can't be. I'm paying 6 and I'm only earning 4. 6 minus 4 is -2. I've lost 2%. But I am telling you the truth. The banker is correct, because if we run the math on that, let's look at it. Your monthly payment is $483.32, which means over 5 years or 60 months, you pay $28,999 for that automobile that you bought. However, the $25,000 that's sitting in that really good bank earning 4% over the exact same time frame grows to $30,525. Now, is that possible that you just made more money earning 4% when you were paying 6? Or do we do math differently here in Buffalo, New York than you do where you're at? It is possible. You actually made $1,526 more by doing it this way. And a lot of you are looking at it saying, how is that possible? Well, it's actually quite simple. You see, the $25,000 that was earning the 4% continued to earn uninterrupted compound interest, which means that money just kept going up, while the car loan, as you were paying it down, the balance was going down. So one is going up and one is going down. And the only thing this example proves to you is that it is possible to make more earning 4% when you're paying 6 all day long. So what we're going to go over today is the money multiplier method. And really the money multiplier method is just going to show you a life-changing method on how to use your money the same way the banks do. And what we're going to do is we're going to talk about 3 things. First, we're going to talk about the machine that we use, the machine that we're going to use to move your money just like the banks do. The second thing we're going to talk about is the marathon. Now, building wealth is not a sprint, just like life is not a sprint. Building wealth is a marathon, and your life is also a marathon. So we're not going to do any get-rich-quick schemes here. This is simply how the wealthy build wealth and how the banks have been using money their entire existence that you have not been doing. And we're also going to talk about everybody's favorite topic. We're going to talk about the topic of your goal. Maybe your goal is to become a millionaire. Maybe your goal is to become a billionaire. It doesn't matter. This will be a method that will help you obtain your goals. But let's talk about this machine. This machine we're going to use to build your wealth and keep your money in your family. This machine is nothing more than this. It is a dividend paying, specially designed and engineered whole life insurance policy from a mutually owned company. Now, I know what you're thinking. Before you stop, I know what you're thinking. You're thinking, what the heck does a whole life policy have to do with me building my wealth? And here's the answer. It has everything to do with it, because this is what the rich do. This is what the elite do. This is what the wealthy do. The number one purchaser of whole life insurance in the world is conventional banks. They own more whole life insurance than they do all the land and the buildings combined. Now, why is this? Is it because banks are stupid? Or is it because banks know something that you and I don't? I'll let you answer that one. But the answer is because they know something the rest of us don't. And this is not something that I invented. This is not something that is new. This is something that's been around for over 200 years. And our tax code's only been around since the 1913s. This has been around longer than the tax code. But, I always like to prove things. So what I'd like you to do is Google that right on the screen. Google BOLI, B-O-L-I. It stands for bank-owned life insurance. And what you will see is you will see how many pages come up. Because what you're going to see is you're going to see how many whole life policies banks use and buy every single year, because it is called BOLI, bank-owned life insurance, and that is the way you're going to check on that. And also the other thing I want to point out is, you remember that really, really good bank? That really good bank we were talking about just a moment ago that you earned 4% on? Now, I know that there is no banks out there paying you 4%, but you see, I wasn't talking about a bank. That 4%, that's how much the insurance companies, the mutually owned insurance companies, pay you guaranteed. That's right. These specially designed and engineered whole lives that I'm talking about, because these are not a standard whole life that you just go to your insurance store and buy off the shelf. This whole life pays you a guaranteed 4%, which is exactly what we were talking about when I said you can earn more when you're earning 4 and paying 6. So let's dive into how a bank actually operates. How does a bank actually work? Well, if we take our money like we did in the last example and we put our money into the bank, let's just assume we deposit $100,000 into our local conventional bank. And our local conventional bank agrees to pay us 4% interest. Okay? To us, our deposits are assets. To the bank, our deposits are liabilities. And the bank doesn't like liabilities, so they want to convert liabilities into assets. And the best way for them to do that is to loan that money out, because a loan to a bank is an asset. So the bank is going to turn around and they're going to lend that money out so that your neighbor can go and buy their new home. And you're probably like, thank God my neighbor's leaving. But that's their new home, and the bank charges them 7%. They pay you 4, they charge them 7, and the bank makes the spread. And all the bank does is exchange the loan for the money that they need in the form of a mortgage. Your neighbor exchanges that loan money to the seller of the house in exchange for the keys. You see, money's nothing more than a means of exchange. And then the seller deposits the money back in the bank. And what does the bank do? The bank lends that money back out to you to go buy that new BMW M4. And that BMW M4, the bank writes you a loan and charges you 8%. Now remember, the bank is paying you 4, but now they're charging you 8 to buy that M4. You exchange the money to the dealership for the keys to the car, and the dealership deposits the money back in the bank. Then the bank removes that money again, and they loan that money back out to somebody to do a home remodel. Maybe somebody's doing a new kitchen or a bathroom. Got to make the wife happy and you got to make the husband happy. So the wife gets the kitchen, the man gets a man cave. So the bank charges 9% on that loan. The person doing the remodel exchanges the money from the loan to the contractors, and the contractors deposit the money back in the bank. And then you decide to take a trip to Las Vegas because you're so excited about your new M4, you're so excited about your man cave or your new kitchen, that you take a trip to Las Vegas and you put it all on black and it hits red, and you rack up some debt. So you go to the bank, and the bank gives you a debt consolidation loan, which out of all these loans that the bank just made is the only one that is not secured by an asset. So it's an unsecured loan. They charge you 12%, you pay off the credit cards, and the credit card companies deposit the money back in the bank. In every one of these transactions, who's in control? Are you in control, or is the bank in control? The bank is in control. And how much risk is the bank actually taking to do all of these transactions? The answer is not much. But doing this, the bank is making a spread. So in the first example where you were earning 4% on your deposit, but the bank lent it out at 7%, the bank made 3% spread. Then they're paying you 4 and they charge you 8 that car. So 8 minus 4 is 4% the bank made. Okay, they're paying you 4 and they're charging you 9. So 9 minus 4 is 5% the bank made there. And then on that debt consolidation loan, 12 minus the 4% is 8. So how much money did the bank actually make by moving your money and everybody else's deposit money? Well, if you add those up, the bank made 20%. How many of you would be okay making 20% on your money? I think all of you would be, but you're only making 4%, which means the bank didn't actually make 20%. The bank made 5 times more than you did, which means the bank made 500% more than you did on your own money, because You were taught to give up control of your money. Welcome to what banks do very well. And the one thing I will tell you, okay, is a lot of you, when I tell you that banks make between 400 and 1300% on the money you leave there, you will say, no, they don't. You won't believe that, so I prove it. Go to bauerfinancial.com, and what you will find is you can pull up any bank for any time, and they will give you an annual report that will show you how much the bank makes on the deposits that we leave there. And you will see that there is not a bank out there that makes less than 400% annually on your money. On the main corner, any town in the United States, what is there? Your answer should be there's a bank. There's a branch office of a bank on every corner of every town in this country. And are they the nicest properties in the town? Absolutely. You're paying for it, so why shouldn't they be the nicest? Every day that I go to the bank, there's some sort of giveaway the bank's doing. And I love it. I go up, I make my deposit, and right there in a little cup above me is a cup full of suckers. I love my sweets. So I grab whatever flavor I want, strawberry, grape, lemon. I grab whatever one I want. I like the grape ones. And when I unwrap it and I enjoy the sucker, I look at the wrapper. What does that wrapper say? It says Dum Dums. Go to any bank, and I bet you any money their sucker says Dum Dums on it. Are they trying to send us some type of a message? You know, my wife has it even figured out more than I do. She goes to the bank to make deposits, and she comes home with an umbrella, a new toaster oven. The bank's always giving something out. Well, that's because they're making 400 to 1300% on the deposits that we're leaving there. And, you know, don't be mad at the bank. They've just learned something that you haven't learned yet. But that's what you're going to learn today. You're going to learn how to become the bank. And not only that, doesn't the bank charge you more and more interest as you start using more and more credit? They do. They've got this so figured out. So earlier, when I told you that banks are the number one purchasers of these specially designed and engineered whole lives, the thing I said is the bank stupid, or do they know something you don't know? Well, now you probably should know that banks are not stupid. Banks know something we don't know. And not only that, banks understand statistics. So let's talk about the annual spending of money. This is how most people spend their money. Most people, out of every dollar they make, they spend 20 cents of every single dollar on automobiles, the payments, the gas, the upkeep. Then they spend 30 cents of every single dollar on housing. Okay. And then 40 cents of every single dollar goes to everything else: diapers, travel, entertainment, food. So out of a dollar, 90 cents of that dollar goes to someone else, and 10% goes to you for your savings. As of about 18 months ago, the average savings rate was between 5 and 6%, 5 or 6 cents of every dollar, not 10 cents like I just showed you. And prior to the recession, the Great Recession, the savings numbers were actually negative. Most financial advisors talk to you about how much money are you saving today, or how much risk do you want to take to make more money. Well, if you can't save more and you don't want to take more risk, what options do you have? How much risk do you really want to take on your money? Think about this. I'm just telling you exactly what's going on out there, folks. And I'm not going to talk to you today about how much money you're saving. I'd rather talk to you about how much money you're spending, because I'd rather take some of the money you're spending and show you how to build wealth by simply taking back the money that you're giving away, the money that you're losing control of, and the money that everybody else is taking from you. If you want to build wealth, start with looking at where all your money goes, and let's find a way to take back that money. And let me show you what that would look like. Now let's look at what would happen if we moved all of the interest that you're paying to everybody else into your savings. Now, on average, we talked about that 20 cents of every dollar that goes to automobiles. What if I showed you how you can take back the interest that you're giving to all the banks and the automobile finance companies? Well, if I could show you how to do that, you then would be able to take back 5 cents of every single dollar, which now means we just added 5 cents to your savings, which effectively means we just increased your savings by 50%. And all we did is took back just the interest that you're giving away to everybody else for the cars that you're buying. And today, I already told you, I'm going to show you how to get back all the money for every single car that you ever buy, drive, and own by applying this one step in your lives. But now let's talk about the bigger one. Let's talk about your housing. Let's talk about the housing and the interest that you're paying on the mortgage. Now, we just did the car, but let's really go into the 30 cents of every dollar you're giving away on the housing. Out of that 30 cents, 25 cents of that 30 is going to interest. Don't believe me? Great. Why don't you look at the mortgage statement? For any of you that have a mortgage, take a look at your mortgage statement and look at, on that mortgage statement, how much money is going to interest and how much money is going to principal. Well, if your mortgage is about 7 years old, in the first 7 years of almost all mortgages, you are giving away 80 to 85% of every single payment you make on your mortgage to interest. You see, this is what the banks know. The banks understand the velocity of money. So the banks have figured out how to get the most amount of money from you in the first 7 years. Do you know why? Because the banks also figured out that every 5 to 7 years we move, or every 5 to 7 years we refinance our original mortgage, which means we reset the clock, which means the bank then gets to make 80 to 85 cents or 80 to 85% of every mortgage payment goes directly to interest. The bank is winning. Even though your interest rate is low, if the bank came out with a loan savings or a loan sale and they put it up, mortgages, 30-year mortgages, 1.5%, there'd be a line a mile down the street, maybe 2 miles. But you see, the bank would be laughing the whole time because the bank knows that for every mortgage they write, they're getting all the interest up front in the first 7 years. And I guarantee you, every person that watches this video, if you really think about that and you think about how often you've moved or how often you've refinanced your house, most all of you have fallen right into that 7-year statistic. You see, the banks are so smart. They did the research on this and they figured that out. And what they did is they found out how to capitalize. So if all we did is we moved that 25 cents of every dollar you're giving to the bank into your savings, because we found a way to take back that interest that you're giving away, you just increased your savings huge. But now let's go to the next one. The next one is everything else. The food, the entertainment. I bet you some of you are using credit cards. And I know we always have the best intentions to pay those credit cards off, but we don't always get around to it. So even though you want to pay the credit card off, some of that money is going to interest. So let's just say we found a way to pay that credit card off every single month, and we didn't have to give that 5 cents away to everybody else. We were able to keep that 5 cents in our savings. Now, this is what your savings would look like. How do you guys like the way that looks? Because I'll tell you what, that looks a heck of a lot better than the prior example, because now all the money that you were giving away, the interest you were giving away, is now going to you in your savings. So this is how you build wealth. You take back the money that you're giving away to everybody else, but you can't do that until you learn how to take back control of your money. So let's move on to the next, which this is my favorite part of this presentation. I'm going to now show you how to get all the money back for every single car you will ever buy, drive, and own. And before I do that, the first thing we need to do is we need to look under the hood of the machine that's specially designed and engineered whole life, because I know all of you are still thinking that you know what this whole life does, but you do not, because you've never seen a whole life that works the way this one does. So let's look under the hood. First off, when you think of a life insurance policy, the money that you're going to give to the insurance company is a premium, and you don't like premiums. You think of premiums as a payment, but you see, in this concept, in this specially designed and engineered whole life, your premiums are deposits. So we're going to call premiums premium deposits. Secondarily, many of you are thinking, yeah, but Chris, I'm too old. Well, here's the thing I would tell you about this. Age does not matter. If we took a 30-year-old and a 60-year-old and we put the same dollars, that $10,000 you see on the screen, if we put that into this specially designed and engineered whole life, that $10,000 would grow to the exact same amount for the 30-year-old or the 60-year-old. But there would be one big difference. That one big difference would be the death benefit. You see, the cash that you'd have in your account would not change, but the death benefit would. The 30-year-old would have significantly more death benefit than the 60-year-old would. But the thing that I love about this is I've never met anybody in my life that cares more about the money that somebody's going to get the day they graduate. When I say graduate, I mean the day they die. It's just a nice way of saying die. So from here on out, graduate is not from high school or college. Graduate is the big graduation date, the day you die. So the 60-year-old would have less death benefit than the 30-year-old would, but the cash remains the same. So let's focus on enjoying the money while we live. And let's go on to the next one. So now what we're going to do is I'm going to show you how this machine works, and I'm going to give you an example of buying a car. Okay, so here's the car that we're going to do. But to buy a car, we first have to discuss ways of buying a car. And I know of 3 ways you could buy a car, technically 4. You could pay cash for a car. Okay, you could save up and pay cash, which is what we're going to look at doing here. You could finance a car and give interest payments and principal interest payments to the bank every month in exchange for the right to drive the car. And after 5 years, the bank made money on interest on you, but you've got a depreciated car. Or you could lease a car. And in that, you just exchange monthly payments for the right to rent or technically drive the car for a certain amount of time. And there's always the 4th way of obtaining a car, and you can always steal a car, but we're not going to talk about that. What we're going to do is we're going to talk about you buying a car just like you'd pay cash for it, but we're going to change one thing, folks. We're going to change where your savings goes first. We're going to add one step. That step is this machine. And in this example, I'm going to show this client depositing $10,000 every single year for the next 7 years into this specially designed and engineered whole life. And now while they're saving this, and don't get hung up on the numbers, 10,000 is just the example here. Any dollar amount that you want to deposit, you can. Okay, so the max is $1 million per year. The minimum is your age times 10. So I'm 43. So my minimum to make this concept work would be $430. $43 or 43 years old times 10 means $430 a month would be my minimum, and my maximum is $1 million a year, just so you know. But we're going to talk about depositing $10,000 a year into this plan. Now we're going to deposit that $10,000 for the first 3 years. Now you can see in the first year, we put $10,000 in, have roughly about 60% of your money available in the first year. Most whole life policies don't have any money available in the first year, the second year, and hardly any money in the third year. But the way we're designing this, you're going to have between 60 and 90% of your money available immediately in the first 30 days. That's correct. So you can see we make a deposit of $10,000 in year 1, and we have $58.73 available. But what we're going to do here is we're going to then keep saving for the first 3 years. In the third year, we had $29,204. Okay, that's how much money is accumulated. How much did we put in? $30,000, and we have $29,204 available. So we're going to take $25,000 out, and we're going to go buy that automobile that you want. We're going to buy your car. But if you were to have bought a car with option 2 or 3, you would have been exchanging monthly payments to the bank for the right to drive that car. So now you are the bank. This specially designed and engineered whole life became your bank, your machine that you're going to use to buy the car. So what you need to do is you need to treat your money the same way you would treat the bank's money. And in doing that, you have to value your money. So when you take that $25,000 out to buy the car, you took that out as a loan. So when you take a loan out, what should you do? Well, you should set the loan up and pay it back. You should treat your money the same way you would have treated the bank's money, because we're not going to change anything here, folks. You're buying a car using your bank instead of their bank. And in doing that, if you use their bank, you would have been okay giving their bank monthly payments. But what you're going to do is you're going to give your bank those same monthly payments. So you're going to make $500 monthly payments, or roughly $6,000 a year. You're going to make those monthly payments to your bank, not theirs. And I don't know anybody that would have a problem doing this, because if you were willing to give your local community bank or commercial bank monthly payments, why would you have a problem paying your bank back those monthly payments? It's way more fun because every one of those payments goes into your account and becomes available the next year. So let's just kind of do the math here. I want everybody to understand what we did. We deposited $30,000 over the first 3 years. In the third year, we accumulated $29,204, of which we took a loan from the insurance company for $25,000. Now, because we took that loan for $25,000, and these are specially designed and engineered whole lives, the insurance company is still paying us interest and dividends on the full $29,204. So this right here, the $25,000 loan, you have $4,204, which means there's $29,204 that is still earning the 4% guaranteed interest the insurance company agreed to pay you. Plus the insurance company every year is going to pay you a dividend. But let's just talk about this. You're still earning 4% on every penny of your money, even though you just took $25,000 out. And what we're going to do is we're going to then write ourselves $500 monthly payments, just like you would have done to the bank. And we're going to put that money back into your bank instead of their bank. I just want you to see what's going on here and how we're actually doing this before we move on. So now, over the course of 7 years, we have deposited $70,000 into your banking system, okay? Years 1 through 7, $10,000 each year. And it doesn't have to be every year. You can do this monthly as well. You could have been depositing $833 a month. It doesn't matter how you get the money into your banking system. It just is shown here as $10,000. So we put $7,000 in. Now, when we took the loan out from year 3 to 7 for a 5-year period, we paid ourselves back $500 a month. That $500 is the same money you would have given to any other bank or any other leasing company, except for now you're the bank, so you pay it back to yourself. So how much did we pay for that $25,000 car? $30,000 with interest. So we paid $6,000 a year for 5 years. We paid $30,000. So 70 plus 30 means that we injected $100,000 into our banking system. Okay, $100,000 is the total injection, but we also bought a car. So out of that 100 that we put in, we took out $25,000 to buy the car, which means our net injection into this banking system is $75,000. So we put in a total of $75,000 and we have a brand new car in the driveway. Okay. So if that's the math, I want you to really focus on what happened here. We deposited $75,000 net into it. But in year 7, how much money do we have left in our bank? Because remember I showed you earlier, every penny that you put into this bank, every penny that goes in there is earning a guaranteed 4%. That is called uninterrupted compound interest. We're going to talk about this more later. So we have $67,881 in our bank, of which we put in $75,000. So if we do the math, you literally got 91 cents back for every dollar that you paid for that first car. Now, let me ask you, how many of you have bought a car and any car in your entire life and gotten 91 cents back for that car after it's 5 years old? Have any of you been able to do that? No. But here you did, because you changed one thing, folks. You added one step to your life and you added this specially designed and engineered whole life, and you created a banking system and you treated your money the same way you would treat the bank's money. But now I did not tell you that I was going to show you how to make 91 cents of every dollar back. I showed you and told you that I was going to show you how to get 100%, all of the money back. So what happens when your car is 5 years old? Well, it starts getting old, needs tires, brakes start getting old. The car just loses its new car smell. So you go to the dealership in year 8, and what you do is in year 8, you sit in a brand new car, you close the door, and you take a big breath. Oh, it's that new car smell. So we're buying a new car. 5 years later, year number 8, we're going to buy a new car. But what we're not going to do is we're not going to make any additional deposits. Now, I'm showing it where you're not making any deposits from year 8 to 12 into your specially designed and engineered whole life. Okay. I would never, ever suggest that somebody stops making deposits into their bank, because if you would continue earning uninterrupted compound interest, why would you ever stop making deposits? But for this example, we're not going to make any deposits years 8 through 12. And what we're going to do is we're going to buy another car in year 8. Now, remember year 7, we had 67,881 in your cash value. Year 8, we have 51,000 plus the 25 that we just took out for the car. So now we bought the car for 25,000. Now, what are we going to do? We're going to do the same thing we did before. We're going to pay ourselves back instead of the bank that we would have normally financed the car through. So you are the bank. So you're going to make $500 monthly payments back to your bank, and you're going to do that for the next 12 years. So what does the math look like here? Well, for the first 5 years, year 8 through 12, you put no deposits in. but you repaid $500 a month for that automobile that you bought. So you put $30,000 back into your banking system as loan repayments. Okay, you're recapturing the money that you would have given to somebody else. But then we bought a car, so we took 25 grand from the 30. So our true net injection for this second car is $5,000. You injected $5,000 net into your banking system. So now let's do the math. Year 7, when you finished paying off that first automobile and got 91 cents back, you had 67,000 in your banking system. Now, year 8 through 12, you put no new deposits in. All you did is paid yourself instead of somebody else's bank, the $500 a month. So your cash value at the end of year 12, and also I want to remind you, you have 2 bought and paid for cars in your driveway, okay, which have value, but we're not talking about that. You now have $91,000 at the end of year 12 in your banking system. 91,000 minus 67,000 is a difference of $23,000. You made $23,592 from year 7 to year 12 for buying another car. In other words, did you get all the money back for both of these cars at this point? Yes, you did. Well, how do I know that? Well, take 75,000, which is your true net injection from years 1 through 7. Then take 5,000, which is your true net injection from year 8 through 12. What is that? That's $80,000. How much money is in your account at the end of year 12? Well, let's look. At the end of year 12, you have $91,473 in your specially designed and engineered whole life, of which you put 80,000 into the plan. So 91 minus 80 is roughly $11,473. You made $11,473 for buying 2 cars. Did you indeed get back all the money for both of these cars? Yes, you did. But you also have $91,000 in your account that you can use to go out and buy the next car. You see, this only gets better with time, folks. But all I wanted to show you here is I wanted to show you that you can get all the money back for all the cars that you're ever going to buy, drive, and own. And I just proved to you that is possible mathematically, and I showed you exactly how to do that. And all you needed to do to make this happen was change one thing. And that one change is where your money goes first. You're putting your money in 401ks, savings accounts, you're using some vehicle. Here, we just changed where that money went first. And then we carried on and did exactly what we've been doing every day of every year of our life. But there was some rules. Rule number 1, in order to make this happen, is we had to pay ourselves first. That $10,000, that one step that we added was we paid ourselves that $10,000. We deposited that into this specially designed and engineered whole life. And I'm just going to put them right here on the screen. Rule number one, pay yourself first. Rule number 2, pay yourself with interest. You got to treat your money the same as you treat the bank's money. And I don't know a bank out there that's doing loans at 0%. And rule number 3, you have to recycle and recapture the money that you would give away to somebody else. So if you guys like that, seeing how to get all the money back for all the cars you're going to buy, drive, and own, what else does this work for? Well, the answer is it works for everything. But what I'm going to show you next is probably the single most important thing, because I know some of you are like, oh, this is taking a while, but what I'm going to show you next is one of the most powerful things I can show you about how this system, the Money Multiplier method, works. And I'm going to show you a real life example. I'm going to show you one of our clients. This client was a chiropractor. Okay. He was a chiropractor that got himself into a lot of debt. How much debt? Well, let's look. He owed Discover $2,300, Lowe's $9,500, Nordstrom $9,700, Wells Fargo credit card $11,000. He had a private loan for his practice for $15,000. He bought a BMW and had a loan for $22,000. He had a boat, because when you got a house on a lake, why not have a boat? He had a boat for $67,000 loan, condo on the lake for $135,000, and his house was $205,000. So out of the total of all of that, this chiropractor had total debts of $478,774. He's 45 years old. He's got 9 third-party debts, $478,000 in debt, and his total monthly payments to all of these debts is $5,777 a month. $69,000 a year is going to somebody else. That's more money than some people make. So when this chiropractor saw us do this presentation, he said, can you help me? And we said, well, we think so. And we said, well, how much money are you saving? And he says, well, between my 401k and my savings, I'm putting away about $25,000 a year. And we said, well, how do you come up with that number? He says, well, in my practice, a lot of my patients pay me with insurance, but some of them pay cash. Every week I figured out how much money comes in cash and I save that money. So all he was doing, he wasn't changing anything in his life to do what I'm going to show you. He simply changed where his savings went first. That's all. It's very important that you understand we're not having this chiropractor work any harder. He's not going to work any longer. He's not going to take on any additional risk, and he's not going to lose control of his money. He's just going to change that one thing and add that one step, which is that specially designed and engineered whole life. So when we asked him and we ran the math, we said, how long will it take you to pay off all this debt? He took the $25,000 he was saving, divided that into the debts of $478,000, and that means it would have taken him 19 years to pay off all these debts, doing what the bank wants him to do. Folks, what I'm going to show you is I'm going to show you how this chiropractor paid off all of this debt, every penny of this debt, not in 19 years. I'm going to show you how we did it in 6.5 years. 6.5 years without this chiropractor working any harder, without him changing anything, without him saving any more money, without him working any harder or giving up any control of his money, and without him taking on any risk. Folks, I'm going to show you exactly how we did this, and it starts right here. Year number 1, he changed where his money went first. So instead of putting $25,000 in his savings in his 401k, he put it in this specially designed and engineered whole life. And we applied what we call the mapping process. This is what we do for all of our clients, and I'm going to show you how it works, but we create a custom map showing exactly what your goals are, whether it's buying cars or paying off debt or anything you want to do. We create a map that will show you 2 years into the future what this does. What you're going to see here is an abbreviation of what the map will do for you. We do not charge for the map. It is a free service. If we do your banking policy for you, if you come to us for this, we do your mapping and your back-end banking services for free. It's just the least we could do. So here's how we did it, folks. Year 1, the chiropractor took the $25,000 and deposited into this specially designed and engineered whole life. Okay, so he deposits $25,000 and he immediately, in the first 30 days, takes out the full amount he can, which is roughly 60% of the $25,000. So he takes a loan from the insurance company for $14,863. So that $14,863 is a loan that he takes from his policy, okay? And taking a loan from his policy is pretty unique. So how this works is we have $25,000 that we deposit. The insurance company agrees to pay us 4% plus the dividend on all $25,000. But when we take that loan for $14,863, the insurance company never takes our money. The insurance company loans us money from their general account. Essentially, that loan that the insurance company gives us, that loan doesn't ever have to be paid back. So this $14,863 that we take as a loan against our policy, that loan is collateralized by the deposit. The $25,000 that's earning 4% collateralizes that $14,000, but the loan is nothing more than the insurance company giving us part of our death benefit while we're living. So that $14,863 is subtracted from the death benefit the moment you take that loan. And the insurance company is going to charge you interest on that loan, which we're going to talk about in just a moment. But what are we going to do with this $14,863 that we just took out? Well, we're going to pay off debt. First, we're going to pay off Discover, we're going to pay off Lowe's, and we're going to pay down Nordstrom. In doing this, in year 1, we take our debts and we paid down our debts. So now we owe $463,911. Okay. But what we're also going to do is we're going to take this $161 that we used to give to Discover, and we're going to take this $287 that we used to give to Lowe's, and we're going to recycle and recapture that money. In other words, we used to give that money to somebody else's bank. We're now going to take the same dollars and we're going to pay them back to our bank. So the monthly payments that used to be $57.77 are now only $53.29. $448 used to go to somebody else. And now what we're going to do is we're going to have you, just like we had this chiropractor, we're going to have you go to your local bank and you're going to open a segregated bank account. What is that? That's nothing more than you going to your bank and opening a brand new checking account. And what we're going to do is we're then going to set up a bill pay or an automatic transfer for $448, just like we did for this chiropractor. And you're going to take that $448 every month and you're going to deposit that money in your segregated bank account that you just opened. So why would we do that? Because you were used to giving $161 and $287 away to somebody else's bank. Now we're just going to deposit in your bank at your local community or conventional bank. So $448 every single month is what you are now saving instead of giving away to somebody else. So you follow what's going on. The insurance company is paying us 4% on the full amount of our deposit. We take a loan from the insurance company's general account for $14,863. That $25,000 deposit, $14,863 of that deposit collateralizes the $14,000 for the insurance company, and the insurance company subtracts $14,863 from our death benefit, making it so that this loan never needs to be paid back. And the insurance company charges you interest on that loan, but they're paying you interest. And if you remember earlier in this presentation, I showed you buying a car and getting a loan from that really good bank at 6%, and the bank is paying you 4%. That was a really good example to show you exactly what I mean. It is possible for you to make more earning the guaranteed 4% the insurance company is paying you, even if the insurance company charged you the highest interest they can of 6%. But just so you know, by today's numbers, 2020, the insurance company charges you 5% simple interest on the loan. And how much money are you earning on that $25,000? That's 4% plus the dividend, which by 2020 dividends puts you at about 6%. So you're making 6 and you're paying 5. You are making a spread of 1% in this example. I just wanted to be clear because in this training, I want you to understand this because this is brand new. But now let's move on to year number 2. Year number 2, we are going to do the same thing. The chiropractor is going to deposit $25,000 into this specially designed and engineered whole life. Then what we're going to do is we're going to immediately, in the first 30 days, that's what I mean by immediately, we're going to take a loan from our policy for $16,571, and we're going to then go into that that segregated bank account that we had you create at your local bank, where you put $448 a month. That now grew to $5,376. That $5,376 that is in your segregated bank account, that's money you used to give away to Discover and Lowe's. You now keep that money. So what we're going to do is we're going to add the $16,571 from the loan plus the amount in your segregated account, which is $5,376. You now have $21,945 to use. And what we're going to do is we're going to use that to pay off Nordstrom. We're going to pay off Wells Fargo's credit card. We're going to pay off that private loan that you had at 10%, and we're going to pay down your BMW. In doing all of this, your debt dropped to $378,013. This is only year 2, folks. And the amount of money that you're giving away to everybody else that used to be $5,777 is now $3,860, of which you are now keeping $1,917 a month, which you put into that segregated bank account with a bill pay or a transfer. So how did that $1,917 come to be? Well, we had the $400 and some dollars that we were saving from Discover and Lowe's, but now we have $276 that we used to give to Nordstrom, $271 that we used to give to Wells Fargo, $922 that we used to give away to that private loan, and we took those same exact monthly payments that you used to give away to everybody else, and we put them into your segregated account. That's the process that we're going to use for the money multiplier method here. So going on to year 3. Year 3, we're going to do the same thing, folks. We're going to deposit $25,000 into that specially designed and engineered whole life. And in the first 30 days, we're going to take a loan. But now look at this. This is impressive. In the first 30 days, after we deposit that $25,000, we're going to take a loan for $25,541. Isn't that much better than what we were looking at before? We put in 25, but we take out more than 25,000. Folks, what you're seeing happen here is what I talked about earlier, and I called it the marathon. You're seeing the impact of uninterrupted compound interest. You're seeing how the interest is starting to catch up and really build your plan. The first 2 years didn't look good, right? I put in 25 and I only had 14. Year 2, I put 25 and I only had 16. But now year three, you put in 25 and now you take out 25,541, which is more money than what you deposited. So we're going to then take that 25,541, and this is an important part. I want to make this clear. You've now hit the efficiency point in your policy. This chiropractor, after year 3, there's not a day that will go by in this chiropractor's life that he will make a deposit into this specially designed and engineered whole life where he will not get back more money than what he deposited. That's important. Okay, so $25,000 loan, plus we were putting $1,917 a month into that segregated bank account at your local bank, which now means that you have $23,000 of savings in that segregated account. So we're going to take the 25 from the loan plus the 23. We have $48,548. And what we're going to do in year 3 is we're going to pay off that BMW loan. We're going to pay off that boat. So this chiropractor is really excited to drive that BMW and take rides around the lake in that boat because they're both paid off, and we paid down the condo. It's 3 years in, folks. This chiropractor only owes $283,146. Okay, his monthly payments to everybody else is now only $2,100, not $5,700 like it was before. And he's saving $3,677 every month in that segregated account. Let's do a quick recap. The marathon that I spoke about earlier. Well, here's the marathon. In year 1, we put in $25,000. In year 2, we deposited $25,000. And in year 3, we deposited another $25,000, totaling $75,000. But we took loans every year. We took a loan immediately. As soon as we made the deposit, we took the most amount out. So year 1, we took $14,000. Year 2, we took a loan for $16,000. In year 3, we took a loan for $25,000. So over the 3 years, we took out $55,000 in loans, but we deposited $75,000. Now, how much money is left in your policy? Most of you, with your traditional way of thinking about how money works, would take the 75 minus the 55, and you would say, Chris, there's $20,000 left in my policy. But you would be wrong. There is not $25,000 left in your policy. You have 75 left in your policy. Because remember, all of these loans, every one of these loans that we took out of your policy, all these loans were money that the insurance company lent to you from their general account. And they just took these loans from your death benefit. So all they did is they took your death benefit and they subtracted this loans, so equals the net death benefit. That's all they did. So these loans were just an advance of your death benefit. Sorry, my handwriting's pretty crappy there. So the $75,000 that you deposited, every penny of that is earning 4% plus dividends, 4% plus the dividend, which, like I said, depending on what company we use for yours, is roughly about 6% in 2020. In all transparency, dividends can change. They are not guaranteed, but the 4% is 100% guaranteed. So folks, every penny of your $75,000 has been earning interest and dividends the entire time, even though you took $55,000 of that out. This is what the wealthy understand. This is what the wealthy know, and this is what you now know. You now have a method and a way to earn uninterrupted compound interest on every penny of your savings while still having access to use some, or pretty soon you're going to see all of your money. So let's get back into the chiropractor's journey here. We're now in year 4. Year 4, we're going to just continue doing the same thing. We're going to deposit $25,000 and we're going to immediately take out the max loan, which is $26,304. We put in 25 and we just took out $26,304. That's pretty darn good. But we were also putting $36.77 a month into that segregated bank account. That $36.77 again is nothing more than the monthly payments you used to give away to Discover, Lowe's, Nordstrom, Wells Fargo, the private loan, BMW, and West Marine. The chiropractor used to give this money away to everybody else. He's now putting it in his account. So that totals $44,124. So if we add the cash value, the loan, $26,304 plus the $44, we have $70,000 in year 4. So what are we going to do? We're going to pay down the condo. But unfortunately, in year 4, when we pay the condo down, and all of you, you have a house, if you pay your mortgage principal down, does your monthly payment change? No. And nor does the chiropractor. So his monthly payments stayed the same, but his amount owed is now 162,324. The amount he's giving away to everybody else is still 2,100, and the amount he's putting every month into his segregated bank account is 3,677. So now we're in year 5. We're almost there, folks. Stay with me. Year 5, we deposit $25,000 in his specially designed and engineered whole life. We take a loan for $27,090. Plus, we take the amount out of his banking policy, or not banking policy, excuse me, his segregated bank account, which is $54,672, meaning he has 54 plus the 27 is 81,762. So we take the 81,762 in year 5 and we pay off the condo, okay, and we pay his house down to 80,562. So now 5 years into this, without changing anything in his life, without working harder, saving more money, without taking on any risk, and without giving up any more control of his money, actually he took back control of his money. What happened? Well, his debts are now 80,562. The only money he owes is on his primary house. His monthly payments that he's giving away to everybody else are only $1,221, his monthly mortgage payment, where he's saving $4,556 a month, money he used to give away to everybody else. He is truly building wealth by taking back the money he was giving away to everybody else, just like I showed you in the annual pattern of spending. But if this chiropractor stopped right here, would that be a good day in the office? Absolutely. All he owes is his primary house. But in any game, any professional sports game, do we stop right before the game's finished? No, we finish the game. Well, this chiropractor is going to finish the game. So we go to the final year, year 6. Year 6, the chiropractor wants to deposit the $25,000 in the banking policy, but he can't. You see, there's some rules, some IRS rules called the MEC 7 pay rule. Now, I'm not going to get into that here. We'll answer that on the call that we set up with you. But this chiropractor could not deposit the full $25,000 anymore. He hit his limit. So in year 6, the chiropractor could only deposit $10,000, not the $25,000, into that specially designed and engineered whole life. So he does. He deposits the most he can, $10,000, and he immediately, in the first 30 days, takes out $13,092. Now, let me ask all of you. If you deposited $10,000 into your local bank and 30 days later you went back and took out $13,000, what was the return on your $10,000 deposit? Let me give you a guess. Your return was 30%. Your actual return on that $10,000 deposit that year was 30%. 30% is what this chiropractor made in year 6. So he had $13,092 to use. He was saving $4,556. All money he was giving away, he was putting that in that segregated bank account. He's got $69,033. He was so excited at this point. He says, you know what? I want to continue putting that $25,000 away. So what do? We do the same thing every bank in every city, state, and town does. He opened a second branch. He opened a new branch office, which is a second policy. That second policy opened allowed him to put another $25,000 in. So he deposits $25,000 into the second banking policy. He now has 2 specially designed and engineered whole lives in his banking system. One he can put $10,000 in, one he can put $25,000 in. The $10,000 one is incredibly efficient because of all the uninterrupted compound interest. So he takes 13 from that. His $25,000 he puts in, same as before, he takes out 14. So 13,092 plus the 14,863 loan from branch office number 2, plus the amount of money he recaptured in that segregated bank account means that when you add them up, he has $97,588 to use. How much does he owe? $76,450. So we pay off his house. We are roughly 6.5 years into this journey with this chiropractor. This chiropractor is now 100% he is debt free. He's completely out of debt. He is now saving $5,777, which is going into that segregated bank account every month. That's just money he gave away. He's now saving that. So let's really take a look at that map. So what you saw was an abbreviation of what we do behind the scenes for you and for every one of our Money Multiplier clients. We don't charge for this service, but we create a map that looks like what you're seeing on the screen. This is the debt map. It shows your deposits into the specially designed and engineered whole life. It shows the loan we're going to take immediately in the first 30 days. It shows what we're going to pay off. There you can see it, the Discover and the lows. We brought them to zero, meaning we freed up 160 plus the 286. We took that and then we show that miscellaneous account right here. All the miscellaneous account is, folks, I want to bring this up because I've done this many times. This is nothing more than a segregated bank account in your local account. That's all this is. And all this 447.87 is this 160 plus this 286. And how much money did this chiropractor actually make? Well, he was given Discover 21%. So on this 160, he's paying back to himself. He's making essentially 21%. And right over here, 286.99, he was given 11% to Lowe's, so he's making 11%. But all of this is what we're going to be putting into that segregated bank account. The one thing we did not show in this is we didn't show why this chiropractor, after he was all done with this, why he didn't take this money and pay off the loan. Well, let's get into that because he does. He just didn't do it while he was paying the debt off. We used the segregated account because it was more efficient. But you see now moving forward, this client was on a journey to become a millionaire. And he became a millionaire by not working harder, not taking more risk. He did it by taking back the money he gave to everybody else. Just like if you were to eat an elephant, how would you do it? One bite at a time. If you wanted to get to the top of a mountain, how would you get there? One step at a time. A man or a woman doesn't fall on the top of a mountain. And if you do, that would be odd, but it's not possible to owe no one nothing. What I mean by that is a lot of people see that example and they say, oh, I don't have any debt. This isn't going to work for me. It isn't possible to owe no one anything. Okay. The machine works for debt, as I showed. It works for paying off your cars and getting all the money back for every single car you're going to buy, drive, and own. But it also works for vacations. It works for buying homes. It works for buying real estate and investment properties. It works for paying your taxes. It works for everything. What we're talking about is commonly known as the infinite banking concept. And an infinite means there is an infinite number of uses on how this works. But remember back to that chiropractor. Let's go back to what he really accomplished. And let's just talk just about the condo and the house that he had. So he had mortgages on his condo and on his house. His condo was $879 a month and he had 251 months left to pay, which means for that condo, if he went and paid the bank every month, the same way most of us do right now, we pay the bank a monthly mortgage payment, he would have paid for that condo $220,000. Now the house, he owed $1,221 a month times 24 months. So he would have paid $273 with interest to the bank for his house. The combination of these two is $493,967. This is what most of us, the plan that we've been taught to follow, the plan that the bank wants us to follow, this is how much we would spend on the condo and the house. And this is how much the chiropractor would have spent. Except for the chiropractor changed that one thing, added that one step, and followed this system. So now that $493,000 is not going to someone else's bank. It's going to his bank, which also could be going to your bank. But you see, there's one extra thing that we didn't hit. You see, this chiropractor, when he was done paying all of his debt off, he didn't just keep putting that money in the segregated account. He changed and started paying the loans that he took from his policy back. Because why keep the money in a regular bank account paying you next to nothing when you can put it into your policy and earn 4%? So if he were to just take this money that he would have given to the regular bank for the condo and the house, if he were to earn just 4% compound interest on that money, here's how much money he would have had and how much money he actually indeed will have. $749,611. That's right, folks. That's how much money this chiropractor was able to make and keep by changing just one thing, by adding one step to his life, which is this silly, specially designed and engineered whole life. And by following our mapping process, this is the outcome. Now, I just showed you something that I learned many, many years ago and something I've been practicing and using in my life. I showed you something that now you know And it would be very, very important, because if you didn't tell everybody else about this, you're literally stealing from your children and from your grandchildren, because now you know about this. Now it's time for you to look at how this would work in your life. And by the way, there's a couple things we really didn't talk about. Number one, did we even really talk about the death benefit, except for when we take loans, it comes away from the death benefit? No, but there is a death benefit, and your beneficiaries will receive that death benefit upon your graduation tax-free. How about the loans? We did talk about those loans, right? They don't ever have to be repaid. The loans are in advance of your death benefit. So why would we not do this? Why would we not take loans? I don't know. Taking loans, they don't have to be repaid, but we always show you and teach you how to repay those loans. How about the internal values that built up? Remember that last example, the guaranteed 4% that chiropractor earned on the house and the condo, that $700 and some thousand? All that gain was potentially tax-free and tax deferred if it's built right and it does not become a MEC, which we know how to do this. The other thing too that we didn't talk about is right here. Policies, these plans that we build are exempt from judgments in liens in most states. So if you're somebody that is in a high risk or a high probability of being sued or having judgments, this asset is protected. You guys know who this is? Warren Buffett. And Warren Buffett says, if poor people would just do what rich people do, they wouldn't be poor anymore. If everybody out there would just change one thing and follow and mimic what the wealthy do, they wouldn't be poor anymore. That's Warren's words. Only one of two things is going to happen to us, folks. Number one, we're going to live, or number two, we're going to die. The question really comes down to, are we better off with this or without this? I think you know the answer. We are certainly better with this, dead or alive. And this is the most profound quote I have ever been able to recite. It is from Will Rogers. Will Rogers says this. He says, the problem in America is not what people don't know. The problem in America is what people think they know that just ain't so. A lot of what you've been taught about money may not actually be the truth. And I need you to keep an open mind, because in this training, in this webinar that I just did, I challenged you to think differently about how money worked. And people will fight that thought. Just like this quote says, people think they know what they don't know, but that's not the problem. The problem is not what people don't know. You now know this. Don't let other people tell you that they know better. Get around people that know what they're doing. Get around people that are living your perfect day, and start changing your life by taking action. And here's how you do it. You want to join the movement? Take back control of your financial situation. If you want to get on our calendar, here's what you can do. We will set up a call and answer all of your questions. Just text Money Multiplier to 33777. And what we will do is we will send you our calendar so you can schedule a time with us, and that call will be nothing more than us answering questions. We are not going to try and sell you anything, because if we do our job properly and teach you how to change your financial situation, how to change your financial life by just changing one thing, we won't ever have to ask for your business. You will ask us to help you. So text Money Multiplier to 33777, and let's get you on the path to financial freedom. Thank you all for joining me today. I hope you enjoyed it. We'll talk to you soon.